Happy New Year, everyone. I hope you stayed safe and enjoyed some downtime during the holidays. What better way to start off 2021 with a video on the important lessons that I learned last year, one of the craziest years the stock market had ever. I learned a lot. Some lessons were more painful than others, but the key to investing, like everything else in life, is practice, experience, and knowledge. So after much thought, I came up with 12 lessons, which I will share with you in this video. Let me tell you that there's no better way to fast track your experience and knowledge managing your own stock portfolio than a good old-fashioned stock market crash. I definitely learned a lot more in the last 8 months than I did in the last 8 years of investing. So how did my passive income strategy, which focuses on a dividend income, fare during the stock market crash? What are the important lessons I learned? And more importantly, how will I adjust my portfolio and strategy to be in a better position for the next stock market crash? So let's answer some of those questions right now. Lesson number one, I owned way too many stocks. So at the beginning of the year, I had about 120 holdings. Pretty crazy, right? Now, it's not necessarily bad owning a lot of stocks, but I did have a lot of redundant stocks, which I sold off and invested elsewhere. For example, I owned many funds that invested in the same types of stocks and sectors as other funds. I realized I preferred some over others, so why have so many? Might as well keep the ones you really like, right? I also had way too many single stocks or individual companies, so many of which were already included in the ETFs that I already owned. So stocks like, for example, Bell, TELUS, CIBC, Scotiabank. Now, these are great stocks and great companies, don't get me wrong, but why own them individually when they are already included in ETFs that are specifically designed for income? Not only do you get more dividend income, but your risk goes down because you're not owning the companies directly. For example, the 4 stocks that I mentioned are already in ZWC, my favorite ETF when it comes to Canadian dividend stocks. So this lesson prompted me to dramatically reduce the number of stocks in my portfolio. From about 120, I am now at about 55 stocks, so big difference. I might sell off a few more in the future, but I feel very comfortable owning about 50 to 55 stocks. So number one, it's much easier to manage. Number two, there's a lot less paperwork when it comes to filing your income taxes. And number three, it simply allowed me to stick with my personal favorite fund. So 50 is more than enough to get coverage in all sectors and in all regions. Lesson number two, individual stocks have the biggest risk of reducing or even suspending their dividend. So as an income investor where the primary goal is really to maximize your passive income, nothing is worse than a dividend reduction or a dividend suspension. Dividend income is really my bread and butter. So when it gets reduced, it's never good. By far, the biggest damage I took in terms of income was from the individual or single stocks that I owned, especially the smaller companies which tend to have high and attractive dividend yields. So many of these companies canceled their dividend completely or made a huge reduction. So at the beginning of the year, individual stocks made up the bulk of my portfolio at 44%. So this lesson prompted me to sell off many of them and reinvest it elsewhere, taking some losses in the process, but well worth it in my opinion. Right now, single stocks only make up about 19% of my portfolio, and I'm planning on making that number even smaller, somewhere between 10 and 15%. So don't worry guys, I have a portfolio update video coming up for you soon, so you will be able to see my entire updated portfolio. I started this channel being completely open and honest with all of you about what I own, and this will never change. I simply wouldn't feel right or comfortable giving you advice or stock picks without owning the stocks myself. So moving on to the next lesson. Lesson number three, individual REITs or real estate investment trusts are not immune to dividend reductions, but I still love them. So I used to have the mentality that REITs are very safe and bulletproof because it's pure real estate and real estate will always go up and real estate is great, right? Wrong. I learned that even REITs are not immune to dividend reductions. Look at RioCan, for example, where they recently reduced their dividend by 33%. So 6 out of the 18 individual individual REITs that I own reduced their dividend. Some were smaller cuts, like 30%, but 3 of them had a 50% cut. One even temporarily suspended their dividend altogether because it owns hotel properties in the US, and that industry is struggling right now. So I kind of understand that suspension. So this lesson prompted me to be much more careful when investing in individual REITs. It taught me that analyzing REITs is not only important, but it's pretty easy. The payout ratio is probably the most important thing to check before investing in any single REIT. The payout ratio is the percentage of rental income that is paid out to shareholders. So anything over 100% means they are paying out more than the rental income that's coming in. So this can be okay in the short term, and especially if it's a tiny bit over 100%. It's pretty common actually, but REITs with payout ratios under 100% are definitely more sustainable. The lower the better. So this also prompted me to look for safer ways to invest in real estate or REITs, and I found amazing ETFs that are not only much more safer, but are also well managed and reliable. IDR, for example, from Middlefield would have to be my favorite real estate ETF. So check out the video where I go over my favorite REIT ETFs if you haven't already seen it. So I'm definitely not giving up on investing in individual REITs, but I will definitely be more careful going forward. I also decided that for me personally, I don't want more than 20% of my portfolio to be single REITs. Lesson number 4, diversification really is important. So this is a very clear lesson during any stock market crash. The crash really shows you that there are always winners and there are always losers no matter what. So being diversified for me is really a safety measure. Like we all saw, energy, financials, and real estate got hit pretty hard, but technology, healthcare, and gold stayed very strong. So having a diversified portfolio is important for us passive income investors because we should really try to get a piece of everything. Like Warren Buffett says, business won't always be consistent. Sometimes it'll be good, sometimes it'll be bad. This is inevitable. So by having a diversified portfolio in terms of sector is really a no-brainer if you ask me. I'm not saying you should absolutely be perfectly balanced in terms of sector, but I don't think it's a good idea to only concentrate on certain sectors and in certain regions. This is really a matter of safety, and I want my income to be as safe as possible. As simple as that. Lesson number 5, passive income is really important because no job is safe. So I always knew this fact, but for some, 2020 was really a reality check. Many people lost their jobs, and not only restaurant jobs, but many sectors were hit. I work for Air Canada, and they laid off like 60% of employees. That's pretty scary. Luckily, I wasn't one of them because I work in the IT department. So the reality is, guys, that no job is safe. Steady and reliable jobs are getting scarcer and scarcer with the rise of technology, automation, and AI. So I don't want to sound mean here, but I always laugh when I hear people say that they don't invest in the stock market because they think it's too risky. Your job is much more at risk than the stock market, trust me. You think your job is safer than multi-billion-dollar companies that have been around for longer than you've been alive? I don't think so. So building your own stream of passive income is important because it's like creating your own paycheck. Think about that. Who are you going to rely on? The government? Yes, there is unemployment, but it doesn't last forever and is just survival money. What happens when it runs out? So passive income can literally be life-saving. I really mean that. If you get laid off but are making $1,000 a month in passive income or even $500, it could be a game changer. It simply provides you with a safety net for you and your family. It's simply the responsible thing to do. Lesson number 6, blue chip stocks are king. So if you haven't figured this out by now, then 2020 should have made it happen. Investing in the biggest and most powerful corporations in the world, corporations who are really leaders in their respective sectors, is really the smart and safe thing to do when it comes to investing. They will always have a huge advantage over the little guy. They have the most money, the most influence, and their executives are mostly very smart, talented, and highly educated people. And no matter what they say, the shareholder is king, not the employees. Trust me, I speak from experience. So not only that, but the companies with the most money and most power always seem to grow stronger and consolidate over time, even during bad economic times. So why is that? Well, it's simply because They have the resources to do so. So why be angry or upset about it when it's never been easier for a regular working person like me and you to get a piece of them? Thinking otherwise is simply foolish if you ask me. So make no mistake about it, blue chip stocks are king, and the bulk of my portfolio will always be made up of these companies. So look inside your ETFs, look inside your split funds, your income funds, etc. And if most of the companies inside your funds are blue chip stocks, you're in good shape because these companies are the most sustainable. Lesson number 7, stock market crashes are inevitable and are great buying opportunities. So I won't lie, back in March and April, there was a brief period of time, I would say about 2 weeks or so, where I was literally pooping my pants. The value of my portfolio was going down hard and faster than I've ever seen before, but I quickly realized that there is really nothing to fear. I have a strategy, let me stick to it, and instead of panicking, let me see what the best deals out there are so I could grab some really cheap stocks. Stock market crashes should be embraced, not feared, because like history teaches us, they are inevitable. History also teaches us that the stock market always recovers and comes back stronger than ever before. So this one was no different. Look at how stocks quickly recovered. Stock market crashes can also cause a dividend reduction. So this can be a great opportunity to buy more shares really cheap. Nothing scares investors more than dividend reductions. They tend to really damage and drive the stock price lower. So it could be a great opportunity to buy more shares, which reduces your average share price, thus boosting your dividend yield. So the worst thing you could do during a stock market crash is panic and sell your stocks. It's called panic selling for a reason, and it's never ever a smart idea. So stay cool, stay calm, embrace it, and look for opportunities. That's what I did, and I am much better off than I was in March. And now I can't wait for the next crash. I hope it comes soon. I hope it comes harder than before. It's simply a Black Friday sale, but for stocks. That's how you should think about it, in my opinion. Lesson number 8, covered call ETFs are amazing. Covered call ETFs have been my best performers by far for me in 2020. Not only has the income stayed relatively stable, but in some cases the income actually went up. All the while stock prices were very volatile and tanking. So why is that? Well, covered call ETFs were really designed for one thing: to provide investors with a high and reliable source of passive income. They have definitely delivered in that regard. A second thing these ETFs provide is a small cushion or safety net during stock market volatility like we had last year. This is simply because options become more valuable during volatility. So the covered call income that the fund manager makes for us is simply higher. So 2020 simply proved what I already knew to be true. Covered call ETFs are amazing and very reliable. So much so that I want them to make up the biggest percentage of my dividend portfolio. I like them, I trust them, and they are great performers during volatility. Their primary objective, don't forget guys, is to provide us passive income. A real dream come true for passive income investors like myself. Lesson number 9, split fund corporations are most at risk to miss dividends during volatility, but I still love them. So let's be completely honest here. Split share funds or split share corporations, whatever you want to call them, are some of the most lucrative and high yielding funds that exist out there. Trust me, I have been tempted many times to allocate a huge portion of my portfolio to split share funds because of this. So they're a unique type of investment fund that I like to refer to as covered call ETFs on steroids. But they have a unique trait of having what I like to call a unit NAV threshold, which 99% of the time is $15. This means that once the unit NAV, which is the combined value of one preferred share and one Class A share, drops below $15, the dividend will not be paid out for Class A shares until it goes back up over $15. So because they use leverage, when stock prices fall really hard, split fund prices fall even harder. That's what leverage does. So now, not all split funds are created equal. Some are riskier and have higher yields than others, but others are more balanced and are more reliable. So they have lower yields but have a lot less chance of missing dividends. For example, out of my 5 favorite split funds, 3 of them have not missed a single dividend payment in 2020, which is incredible. One of them missed only 4 dividends. That would be a DFN or Dividend 15. And one of them missed 8 payments. That would be LBS from Brompton. So it's important to really look inside the split fund at the companies in there and check the whole history of dividend misses. Luckily, I did all that for you in my second split fund video, so make sure to check it out. So the lesson here is that you need to figure out for yourself your personal tolerance level and decide what percentage of your portfolio will be split funds. Personally, I feel extremely comfortable with 15 to 20%, but some of you might feel better at 10%. Some of you might be willing to take a more of a risk for higher income and like 25 to 30%. So it's all relative, right? The key with splits is to really understand that you will most likely miss a few dividends, especially during volatility. But over time, in the grand scheme of things, splits are amazing funds that should definitely have a place in any dividend-focused portfolio. The income is simply too incredible to pass up. Lesson number 10, defensive sectors are great since they provide a portfolio with stability and safety. So I am a firm believer in value stocks and sectors. The 3 sectors that I was most impressed with in 2020 in terms of stability and defense were telecommunications, utilities, and healthcare. This was more of a reminder and not an epiphany for me, but nonetheless something important I want all of you to understand. So telecom companies who provide us with our voice and data services like Bell, TELUS, AT&T, Verizon are very stable because they have very reliable income streams. Utility companies which provide us with our electricity like Emera, Fortis, Hydro One, Duke Energy, etc. are no different. They are also very stable and a great source of consistent income. Then there's healthcare corporations like Pfizer, AstraZeneca, Johnson & Johnson. They're very important and have literally saved our lives recently. So they also happen to be great dividend stocks because they are very profitable companies. So what do these 3 sectors all have in common? Well, they provide us with essential services that we all need, pandemic or no pandemic. So everyone needs their internet and phone service, their electricity, and of course their healthcare services, which includes medicine, prescription drugs, and of course vaccines. So I'm not saying only invest in these 3 sectors, but understand that defensive sectors such as these can provide great safety and great stability to any portfolio. So in 2021 and going forward, I think I will place a bit bigger emphasis on these 3 sectors and ease off a bit on financial stocks, which currently make up the biggest part of my portfolio. So I suggest you do the same and really take a look at your portfolio composition. These 3 sectors should be a sizable part of your overall portfolio, in my opinion, if you're an income investor like myself that likes safety and stability in the long term. Lesson number 11, investing fear goes away with time and experience. So if ever you're still scared or hesitant to invest, or if you're a beginner, I totally understand the fear and know that you're not alone. What I want you to understand is that fear goes away with time and experience, like with many things in life that we do for the very first time, like riding a bike. So if ever you feel anxious or feel fearful, I want you to remember one thing. It's normal and it will go away with time. Always remember what investing in the stock market really is. It's buying a piece of a well-established business. Investing in stocks is investing in businesses. Never forget that. What you should really be scared about is missing out on the easy passive income these businesses can provide you and your family. Owning stocks is owning assets, and owning assets is the only way to build your wealth and improve your family tree for generations to come. A job, even if it's a high-paying job, will never be able to provide that because you're the asset, and when you can no longer work, it's over. A corporation never stops working to make profits. Never. Lesson number 12, the passive income investing strategy works. So it's definitely not the most exciting strategy, but it works, and it works best for me. So the fundamental principles of my strategy include only invest in something that gives a dividend, investing for income rather than depending on the stock price appreciation to make your money. Number 3, buy with the intention of holding forever. Number 4, only spend the interest or the dividends, never the principal. This is done by never selling any of your stocks. And last but not least, always think long term. So although it's not perfect, I could tell you with full confidence that this strategy works and is a great strategy that can withstand any stock market volatility in the future. Like I said, stock market volatility is inevitable. Future crashes will happen. So this strategy is very easy, it's simple, and it's very hands off. Using the buy and hold strategy, where you simply care about the income above all else, just gets better and better as time goes on. Think of it as investing in an income producing property. If you're paying 8 to 9% of your mortgage off every year with the rental income that comes in, what happens in about 10 to 12 years? Well, you literally pay off the initial cost of your investment. In this case, it's your mortgage. All the income that you get now, all the rental income, is pure profit going forward. So the same concept applies to my buy and hold income strategy. At some point in time, you will make back all your money in dividends alone. Personally, I already made back about 10.5% of my initial investment. It's not a matter of if, but when. So I know it might not be for everyone. Some people just can't understand why I don't care about stock prices, stock price trends, etc. But when you own an income producing property, do you care that from one year to the next, the value of your property changes? No, the important thing is getting that rent income. Same applies to my strategy. If you really think about it, it's a pretty conservative investing strategy. So after this crash, I'm more convinced than ever that it works and will stand by it until the end. Hopefully you will too, because there's more than enough dividend income for all of us, and we all really deserve to get a piece of it as law-abiding, tax-paying citizens that are just trying to do the best for ourselves and for our families. So there you have it, guys. Those are the 12 lessons I personally learned last year. I hope this was useful to you. If it was, please hit that like button. It's free and it helps the channel out. So it's a win-win. So what are some of the more important lessons that you personally learned? Let me know in the comment section below. Don't be shy. I'm very curious to see what your lessons learned are. The channel viewership is growing, but the positive comments that I get from all of you are also growing. So I want to thank all of you for your support, and I'm so happy and proud of all of you who are taking your financial health seriously and into your own hands. I especially love when I get comments from people saying, hey, I got my first dividend payments. You really seem excited, and let me tell you that the best is yet to come. So this motivates me to keep making videos. So I got a lot more content for you guys coming up, so stay tuned. I will continue to be an open book to all of you and keep showing you my updated portfolio as well. We're also working on a brand new website that we're very excited about, so stay tuned. Make sure you're subscribed not to miss out on the future content. So my mission remains the same, guys. It's to help everyday working Canadians to really invest on their own, to build their own stream of passive income, and eventually become financially independent. If we could do it, so can you. So with that, take care, guys. I appreciate you watching. Stay safe and see you next time.